Copart stock is down over 40% in the last 12 months. Wall Street is treating this wide moat compounder like a failing business. Today I'm breaking down the actual numbers to show you why Wall Street has this completely wrong and why this is the best entry point in years. First, we have to understand Copart's business model, meaning what they actually do to make money. At the highest level, Copart is just an online auction company, similar to eBay, but Copart isn't directly serving consumers. Instead, they work with the largest insurance companies to find buyers for salvage vehicles. Once the auction is over and the highest bidder secures the stock of salvage vehicles, Copart earns a fee. There are all sorts of extras that Copart makes money from, but the basic idea is that they operate an online auction site for salvage vehicles. So now the question becomes, why is their stock price down 40%? There are three main reasons why investors are selling Copart stock right now. The first major concern is that Copart's leadership keeps changing. The company was founded by a guy called Willis Johnson, a legendary entrepreneur who built Copart into what it is today. But when Johnson stepped down from the position of CEO back in 2010, he handed the reins to his son-in-law, Jay Adair. This was great because Adair had been working at the company since 1989, when he was just 19 years old. But in 2024, Adair stepped down to allow a guy from outside Copart's founding family, Jeff Lau, to become the new CEO. Only a few years into Lau's tenure, the news broke on June 29th, 2026, that Lau would step down as CEO, handing the reins back to Jay Adair. The short turnaround and a lack of an explanation for the change caused uncertainty on Wall Street, leading the stock to drop 5% on the day of the announcement. The second major concern is weak vehicle volume. Like I mentioned before, Copart sources its salvage vehicles directly from insurance providers, but with rising insurance premiums, consumers are shifting to cheaper and less extensive coverage. Fewer covered vehicles means fewer damaged cars flowing into Copart's auction yards. This is why the company's revenue growth has slowed so dramatically in recent years. And the third major concern is increasing competitive pressure. The online salvage auction market is basically a duopoly, meaning there are two large players. Copart and their main competitor, IAA, service roughly 80% of the market, with Copart as the undisputed leader. However, in 2023, RB Global acquired IAA. Under RB Global's ownership, IAA have seen improvements in unit volume. This is basically the amount of salvage vehicles they're able to sell. This has led investors to believe that Copart is losing market share. But if we take a closer look at what's happening inside the business, Copart's moat is actually getting stronger. In Copart's recent earnings call, management stated that the long-term growth algorithm is intact, with modest declines in accident frequency more than offset by rising total loss frequency. Total loss frequency is the rate at which vehicles are wrote off by the insurance companies. Higher total loss frequency means growing salvage vehicle volume for Copart long term. And that's the important phrase, long term. Investors don't seem to understand that Copart is a moderately cyclical business. As you can see in this chart, Copart's quarterly revenue has periods of high growth and an occasional slowdown. But the blue bars show that Copart's revenue continues to compound over time. Management characterizes this pullback as cyclical rather than structural. Cyclical pullbacks are the moments when Wall Street becomes most skeptical because they're so focused on the short-term numbers that they fail to see the bigger picture. Despite declining unit volume, the average selling price, or ASP, on Copart's platform increased by 4.6% last quarter. Remember that Copart make money through fees, so any increase in the average selling price benefits their bottom line. The biggest and most important difference between Copart and their competitors isn't their technology, it's actually their land. Copart owns or long-term leases over 10,000 acres of land across more than 280 locations globally. Copart's land ownership strategy creates high barriers to entry for competitors. Have you ever heard the term NIMBY? It stands for not in my backyard. It's basically a social phenomenon where local people and governments are highly skeptical of companies wanting to use land for business purposes, especially when it's a salvage yard like in Copart's case. I mean, who would want a salvage yard next to their house? But Copart secured large parcels of land near major metropolitan areas decades ago, before it became too expensive or heavily restricted by regulators. creating a moat that can never be replicated by their competitors. Now that we understand their moat, I'm going to show you why Copart's fundamentals continue to show long-term promise. If we take a look at Copart's free cash flow, you'll see that despite slowing revenue growth, their free cash flow is still growing pretty quickly at around 13% in the last 12 months. The reason that free cash flow is able to grow faster than revenue in Copart's case is that they've reduced their capital expenditures, more commonly known as capex. The company invested a lot of money in land over the past few years. Now that the investment cycle is over, free cash flow naturally expands. Copart have also been able to increase their operating margin over time. It's up from 32% in 2016 to over 37% today. And this is evidence of Copart's land strategy paying off. Once a piece of land is acquired, paved, and permitted, the cost of maintaining the yard remains relatively flat, regardless of whether 10,000 or 25,000 cars are parked on it. This is also why weak vehicle volume from insurers slows revenue growth short term. But just think about that. Industry conditions are bad right now, but Copart is still producing operating margins above 35%. When things recover, Copart's operating margins should head north of 40% again. Next, I wanted to look at Copart's debt, or more precisely, their lack of it. Copart currently holds $4.2 billion in cash and has zero debt on its balance sheet. This in itself is a great sign of business quality. You'll rarely find businesses at the scale of Copart with a debt-free balance sheet. But what do they do with all of that cash? Other than acquiring new land to expand the business, the company historically only did share buybacks when they thought their stock price was deeply undervalued, which based on this chart was back in 2019. But in the last few quarters, Copart began aggressively repurchasing their own shares. This is the strongest sign that Copart believe their stock is undervalued and a good investment. They bought back over $1.6 billion worth of shares in the last quarter alone. But what about Copart's valuation? Their free cash flow yield is sitting at just over 5%. And from a historical perspective, Copart usually trades between a 2 to 3% free cash flow yield, suggesting the stock could be deeply undervalued right now. It's very rare that Copart stock trades at above a 4% free cash flow yield. So the current 5% yield is what makes this opportunity so interesting. The last time Copart traded at a 5% free cash flow yield was back in 2012. If you'd have bought the stock back then and held until today, the value of your investment would have increased by over 700%, while the S&P 500 index would have provided a smaller gain of just over 400%. Then if we look at Copart's PE ratio, we can see that it's trading at 16 times forward earnings. If we compare this to their main competitor, RB Global, you can see how the valuation gap has got wider and wider. This is despite Copart having a stronger business model and larger market share. So with that being said, I'm going to show you my base, bear, and bull case assumptions for Copart stock over the next 5 years. In my base case, I'm assuming free cash flow per share growth of 15% and a 3.5% free cash flow yield. In this scenario, Copart stock would increase from $27 to $83 per share in 5 years, producing a 25% annual return. But in my bear case, I'm assuming just 10% free cash flow per share growth and a 4% free cash flow yield. In this scenario, Copart stock would still increase from $27 to $58 per share, generating a 16% annual return, doubling over 5 years. So even my bear case is suggesting that Copart stock could be a pretty good buy right now. But what if we're actually bullish on Copart stock? In my bull case, I'm assuming 20% free cash flow per share growth and a 3% free cash flow yield. In this scenario, Copart stock would increase from $27 to $120 per share over the next 5 years. That's a 34% annual return, or 4x upside from today's price, which is why I believe that Copart stock could be a great opportunity for investors right now. Wall Street can say what they like, but when you dig into the actual numbers and the quality of the business, Copart is in a league of their own.